Friends, you are welcome to my YouTube channel AKD Global Education. Don't forget to subscribe this channel so that you will get notification of new videos. Please press like button. It will encourage me to make such videos in future. Today I shall discuss on a very important topic asset allocation for personal finance. Asset allocation is nothing but an investment strategy for creating a portfolio which targets the return and liquidity needs of investors, keeping an eye on rationalizing the risk through diversification of asset allocation means don't put all eggs in a single basket. What is the need of asset allocation? As you know, returns and risk of each asset class is distinct. Hence, performance of investment across varying conditions likely to be different. So, allocate investments across cash or cash equivalent, debt, equity, gold, real estate, and other suitable assets. Better return of some asset in portfolio helps to compensate the poor return of other assets. Determining the proper mix between asset classes is very important. It must reflect the investor's need for return and liquidity with their risks. There are two methods for constructing investment portfolio. First one is strategic asset allocation, in short SAA. Second one is tactical asset allocation, in short TAA. First, I will discuss on strategic asset allocation. It is a long-term strategy. It tailored to specific goals and risk preference of the investor. Allocation of the investable resources to different asset classes done considering goals of investor, investment horizon suitable for the goals, risk-taking ability of the investor. Longer investment horizon helps to take on volatility in returns to ride out multiple economic cycles. Equity allocation in the portfolio will benefit from higher level risk. Principle of asset allocations followed, not align or rebalance on the expected performance of the various assets. Balancing are triggered by two factors. First one is performance of different asset class in the portfolio led to change in preferred or original allocation. Means original allocation, suppose equity and debt weightage was 60-40%, but performance changed the weightage of equity and debt to 70-30. Then rebalancing is to be done to bring weightage to original means equity debt weightage to 60-40. Means you have to sell the equity investment and increase the debt investment. Second factor is a change in goals and risk preference triggered a new allocation. For example, retirement portfolio moves from accumulation stage to transition stage. Means your retirement is nearer, then portfolio allocation redesigned to move from growth orientation to income orientation. It has disadvantages also, likely to underperform when a particular asset class booming. Even if equity market is doing well, but portfolio rebalancing to reduce the holding in equity to bring allocation to origin. Now I'll discuss the second strategy, tactical asset allocation. It is a short term in nature. It makes and rebalances allocation based on expected market performance. It focuses on performance of asset class rather than investors' objective and goal. In conclusion, I can say that portfolio generally constructed using the first strategy, the strategic asset allocation, to get the benefit of tactical asset allocation is used in short term to add some value in their investment portfolio. With this, I conclude my today's video. Thanks for watching my videos. Don't forget to subscribe my video and like my video and share as much as you want.